Bonds are usually seen as suitable for risk-averse investors, and in principle, they can provide useful ballast to any portfolio. A bond is a loan. By buying it, you're effectively lending money for a preset period of time to a borrower, be it a government, a company, or a supranational entity such as the European Investment Bank. In return, the borrower pays interest, the coupon, at preset times, and then at the end of the bond's predetermined lifespan repays your initial investment, which is known as the principal. So, in simple terms, a bond is an IOU. The advantage of this is that you will know exactly what yield you'll get over the life of the bond and that you should get your money back at the end. But there are still three main risks when it comes to owning individual bonds, and they are default risk. If an issuer struggles to pay the coupons or repay the loan, the bond price can go down and you may not get your initial investment back. Interest rate risk. If interest rates rise, bond prices generally fall as holders sell existing positions to buy positions in new issues, which will come with higher interest rates. Liquidity risk. It can sometimes be difficult to sell a bond when you want, at the price you want, in the size you want, especially if markets are volatile. To manage this trio of risks and still target income via the bond coupons, you can also access bonds via tracker funds or exchange-traded funds, ETFs. These funds are designed to track or follow the performance of a basket of bonds, not just one, usually an index of traded loans, rather like the FTSE 100, which is an index of traded stocks. The tracker will look to deliver the performance again of that basket or index minus its own running costs. Now this can take away a lot of the pain in terms of the research you'll need to do if you're selecting individual bonds. A bond tracker can help you own a portfolio of bonds through just one instrument, generating income and managing risk through diversification. But there are still risks involved, and we need to be very clear about them too. The first risk, as already discussed, is that bond prices can go up when yields and interest rates fall, but they can go down when yields and interest rates rise, so the tracker can rise and fall in value too. This first line on the chart here shows how the price of the benchmark 10-year UK government bond, or gilt, traded between February 2016 and February 2017. The second line shows the running yield. Just how the bond's price and yield move inversely is the key here, as is the case of shares. If you think about it, the lower the share price, the higher the yield, and vice versa, assuming the dividend, or the coupon in the bond's case, remains unchanged. The second risk is all about maturity. If you hold an individual bond, buy an individual bond at issue and hold it until maturity and the traded loan is repaid, you will get your initial investment back plus the coupons, assuming nothing's gone wrong at the issuer in the meantime. But bond trackers or actively managed bond funds do not have a maturity date, so this safety net isn't there. A tracker will keep following the index of bonds up or down, so you may suffer a capital loss with a bond tracker or fund that could in theory offset the value of the yield you receive. The third risk is that certain bond trackers will be more volatile than others. The higher the coupon and the longer the maturity profile of the bonds it follows, the more sensitive the tracker will be to changes in interest rates and the more the price of the tracker will probably swing around. The lower the coupon and the shorter the maturity profile, the less it will move around on average. Finally, remember that falling interest rates are generally good news and rising ones generally bad for bond prices. And with interest rates at or near record lows in the UK, US, Japan and the EU to name but four, you could argue the only way for interest rates is up. If rates do rise, it's highly likely your capital value could fall, though in fairness, analysts have been saying that for nearly 25 years in Japan, and they've been wrong, as huge debts, rotten demographics and weakened economic growth have kept bond yields depressed and prices high. To keep tabs on this trend, please pay attention to what the Bank of England says and does at the 8 annual meetings of its Monetary Policy Committee, for example. This is not to say you should not or should own bonds or bond trackers. It's for you to decide whether the yields on offer are sufficient to compensate for the risks and whether they fit with your overall investment strategy, target returns, time horizon and appetite for risk. And as with any investment, you need to consider the potential downside as well as the upside before you commit capital. Thank you for watching, and I look forward to seeing you next time.